All right, the bell's rung on Tuesday, January 6th. Let's get right into the scoreboard. S&P 500 finished up just 0.12%,
Barely. And the Nasdaq did a little better. It gained 0.38%.
but the Dow actually slipped, down 0.05% into the close.
Yeah, and that's the whole story right there. The headline says record highs, but, the closing print tells a very, very different story.
It really does. I mean, we're talking about the S&P hitting a fresh all-time record. The Dow tagged about 49,000
A
intraday,
huge psychological level.
and then it just fizzles out. It feels like a total head fake. What was the narrative that created this choppy mess?
It was a classic tug of war. You had, on one hand, this pure AI euphoria. All the Blackwell-series chip reveals from CES were still fueling the Nasdaq.
Okay, so that's the bull case.
That's the bull case. But that was almost completely neutralized by, real geopolitical shockwaves. The volatility around that sudden regime change in Venezuela really spooked people.
And you can't forget the domestic stuff either. I mean, the desks are all talking about the January 30th government funding deadline.
Exactly. Nobody wants to put on major new positions with that hanging over the market. So what you got was this just extreme sector
A
rotation.
real disconnect.
A huge disconnect. I mean, the leader on the day, by a mile, was energy. It was up over 2.5%.
On that Venezuela turnaround trade, right?
That initial emotional trade, yeah. But then you look at the laggard, consumer discretionary got hammered, down 1.4%.
And that was a reaction to that dismal Cox automotive forecast.
A really grim forecast. They're pointing directly at this jobless expansion, finally hitting the middle-class wallet. People are pulling back on big-ticket items.
So, okay, we've got a market where the leaders are drilling for oil on geopolitical news, and the laggards can't sell cars. That just screams low conviction.
It does, and the internals, I mean, the volume and breadth, they confirm it. This is where you separate the real signal from all the noise.
Let's talk volume then. Today's estimate was, what, 16.2 billion shares?
Yeah, 16.2 billion, which, is barely above the 30-day average of 15.8.
That's nothing. If you're hitting a new all-time high on the S&P, you want to see a massive surge of buyers. Volume confirmation.
You absolutely do, and we didn't get it. I mean, compare that to Monday. Monday's surge was on 19.1 billion shares. That's high conviction.
So the verdict from the real money is
Low conviction. It's nervous consolidation. This tells you the rally to the highs was driven by retail momentum, thin market drifting, not institutions.
the big money was sitting on its hands.
They were, and the market breadth, the advanced decline ratio, was just as underwhelming. It was roughly 1.2 to 1.
For a record high day, that's really weak. You'd want to see 2.1, maybe even 3.1.
Exactly. This wasn't broad-based at all. The heavy lifting was done by, these really concentrated niche breakouts.
Which brings us to another key reversal sign. The Dow actually outperformed the Nasdaq in relative terms.
Yeah, which is a signal of a defensive posture. When the value and quality names in the Dow are holding up better than the high-growth Nasdaq on a record day, that's capital de-risking. It's a flight to safety, not a growth surge.
And speaking of ignoring risk, let's talk about the VIX. It is just pinned below 14.
It's the volatility paradox, and it is just screaming right now.
It feels like total complacency.
It is. The market has completely priced in a stable Fed. They've basically ignored the Venezuela situation, these major geopolitical tail risks. The pricing implies nothing can possibly go wrong.
So when volatility gets this cheap, what's the institutional play?
Well, the VIX is at a coiled spring level.
Yeah.
The risk-reward for putting on new long positions up here is just awful. So the smart money, the real play, is buying downside protection. Puts are cheap.
Because a sudden move is statistically overdue.
Exactly. Complacency is expensive right now.
Okay, let's drill down into some specific stocks because this sell the news theme was everywhere, especially in semis.
Oh, absolutely. This was a textbook negative divergence. The S&P makes a new high.
But the generals of the whole AI trade, they finished in the red.
Firmly in the red. Nvidia closed down 0.4%. AMD got hit hard, down 3.5%.
So the market basically treated all that CES excitement as a known.
It was already priced in. It signals that expectations for AI hardware are now, officially, priced for perfection. Anything less than mind-blowing news is a reason to sell.
And when the generals are retreating while the infantry, the value stocks, pushing the index, that's a problem.
It's a huge structural problem. The rally just lacks the integrity to hold these levels through any kind of real macro shock.
We saw institutions fading the rally elsewhere too. In energy, for example.
Well, absolutely. Chevron is the perfect case study. Huge gap up on the geopolitical news.
And closed down 4%.
A massive key reversal. The realization hit that, rebuilding Venezuela's oil infrastructure isn't an overnight win. It's a multi-year, multi-billion-dollar capex drain. Smart money sold into that emotional pop.
Now, to be fair, there was one big breakout exception, right? It shows where some of that new money is rotating.
Right, the pure data storage trade. It was fascinating to watch. Sandisk, ticker SNDK, closed on the highs, up a massive 25%.
Wow, and Western Digital followed.
WDC was right behind it, up 17%. This shows a clear institutional rotation into what they're calling the long tail of data storage.
Explain that for us. What's the long tail?
It means the obvious trade, the chip that trains the AI model, is kind of done. The focus is shifting to inference, the actual day-to-day running of these models.
Which requires enormous amounts of storage.
Massive amounts. It's a structural shift that benefits these foundational infrastructure players. That's where the next wave of capital is headed.
Okay, so the close was weak, divergent. Let's pivot and look ahead. What's the catalyst for tomorrow?
Tomorrow morning, 8:15 a.m. Eastern, we get the ADP employment print.
A huge volatility event.
It is. The market is obsessed with the labor market right now. If that number comes in hot, it could really test the weak structure we've been talking about.
So for anyone trading the open, what are the key technical levels for the S&P? We closed at 6,944.
Your eyes have to be glued to the gamma wall at 6,915. That is the critical pivot.
Why that number specifically?
As long as we hold above it, options dealers have to stay long delta. It provides a mechanical bid under the market. It's a self-reinforcing support level.
And below that is the danger zone.
That's the danger zone. A clean break below 6,900 triggers what's called a gamma flip.
And that's where selling begets more selling.
Exactly. Dealers are forced to reverse their hedges, which means they start selling futures into a falling market. It's an accelerant. 6,900 is the hard stop if you're long.
Now, despite all these warning signs, we're still in an uptrend. What does the historical data say?
Right. You can't fight the tape completely. The first 5 days indicator gives us about a 68% probability for trend continuation. Plus, you still have that January institutional inflow.
So the message is stay cautious, but don't get outright bearish just yet.
That's it. Be aware that the foundation is fragile.
Okay, so with that in mind, what are the high-conviction day 2 plays that the desks are looking at?
2 names really stood out. First is actually Nvidia.
Back to the generals.
Right. They see today's selling as transitory. They're betting on a technical rebound, a momentum long, looking for the broader sector to push it toward that $200 psychological level.
And the second play.
Freeport-McMoRan, FCX. It's a proxy for copper.
And copper just hit an all-time high today.
Exactly. This is set up as a pure momentum gap and go. If it opens above Tuesday's high, the idea is trap shorts will be forced to cover, fueling a really fast move up.
So to summarize the core takeaway from the institutional desks, what's the one concept?
It's index inflation. The headlines are completely misleading. The price is going up, but the structural supports, the volume, the breadth, the leadership, they're all incredibly shaky.
Which leaves us with a fascinating question. We have a 68% chance of trend continuation, but we also have institutional money clearly selling the leaders and de-risking.
A huge dichotomy, liquidity versus conviction.
So you have to ask yourself, is the market's push toward that next huge milestone, 7,000 the SPX, is that just a self-fulfilling prophecy from all this January cash, or is this weakness underneath the surface setting up the ultimate bull trap? Something for you to mull over.